Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show.
Welcome to another episode of the i3 Insights podcast. My name is Daniel Grioli and I'm the MarketFox editor for i3. Today I'm in sunny Venice, Florida at the Ned Davis Research headquarters, and I've got a real treat for our listeners today. I'm sitting down with three of the firm's senior research analysts. I have Tim Hayes, who's the global strategist. He's a chief global strategist. I have Ed Clissold, who's the chief US strategist, and Joe Kalish, who's the chief global macro strategist. So I've been told I'm very privileged to get these guys all into one room at the same time. So we're going to talk all things multi-asset strategy, tactical asset allocation, views on the market. A question that we usually ask our guests early on in a podcast, I'm going to throw it open to whoever wants to go first. What are some lessons that you've learned the hard way over your careers?
The hard way? Well, I think a lesson, maybe I'll just start with one, which is pretty basic, but it's pretty at the core of NDR, which is don't fight the tape. And that's why, our approach is to make sure at least half of our emphasis is on what's going on, in the market underneath the surface, the breadth, participation. And, when you start to get away from that, that's when you start to make mistakes. So, I think it's a basic lesson, but it's one I learned early on. And I think it's really something that's important to keep in mind.
I think, Joe, you were going to add something there?
Yeah, I think, for me, it's the psychological, being able to admit a mistake. Ned has always said this is a business of making mistakes. And the difference between the winners and the losers are the winners make small mistakes and losers make big mistakes. And, it's hard for me to admit that I'm wrong on things, right? That, my thesis is wrong. But if you want to survive, that's just part of the business and you have to learn to overcome that. And, if you make a mistake, you make a mistake. Even the best investors in the world make mistakes. And once you come around to that view, success is easier to handle.
Does it get easier to accept your mistakes?
I think through experience and through practice, yes, it gets easier to admit it. You become much more humble, and I think that's one thing that Ned has always said. This is a humbling business, and people with huge egos generally don't last long.
And Ed, how about you?
I think those are two valuable lessons. I'll add a third, and that is to focus on risk management. You can have great ideas, great recommendations, great trades, but if you're not careful, then those are going to become an outsized part of your portfolio, and then when they turn, all your good work can be unwound in a short period of time.
So we've kind of alluded a little bit to what Ned Davis does, but perhaps not all of our listeners have heard of Ned Davis or aren't familiar with the research. How would you summarize what you all do here and who uses the research as well?
I'd say we try to get on the right side of the major moves. And that's essentially what we try to do by looking at data, history, indicators, and then be able to assess that and explain to clients sort of where we are in the risk reward spectrum. How much risk is there in the market? Is it a low risk environment? which supports getting more aggressive in your portfolio, or are we getting into a more risky environment? And so that's, I think, the major challenge. I mean, each of us sort of has a different area. I'm doing it from the standpoint of global asset allocation. But that's, I think, really the objective. I think that's what clients come to us for, is we'll accept small mistakes, but we don't want to make a big mistakes, and our clients trust us for that. We're not going to get them on the wrong side of a big move.
When I came in to work on the U.S. product, as Tim became more global, one of the challenges of NDR from a perception basis is that we were very technical, even though we do have a respect for technical analysis, obviously. But we do a lot more than that. We'd like to say there's 4 different pillars. There's the macro economic, there's the fundamental and valuations, and those 2 tell you how the market should be acting, and over the long run it does. But as Keynes was famous for saying, the market can remain irrational longer than you can remain solvent, so you're going to look at the technicals and sentiment for market timing. But I think in the perception in the marketplace was that we weren't as strong on fundamentals, because we weren't saying, okay, stock XYZ is going to earn X dollars per share next year, so our target is Y. So being a CFA, I've tried to build that part out, while keeping in mind that's just one of the 4 areas that we focus on. But perhaps that's a good conversation starter for people who are less familiar with NDR, to look at that. And then as market conditions change, the technicals are very helpful, and everybody seems to appreciate that during the while you're going through it, even though they may say that the biggest part of what they do is fundamental analysis. When it comes to actually managing portfolios, they're a lot more technical than that.
I think when we look at what Ned Davis Research does, first of all, we're an institutional investment research firm where we have a wide range of clients, but large asset managers, hedge funds, endowments, pensions, family offices, and the like. But I think what Ed was really describing is what we call a 360-degree approach to investing. We approach investing from multiple perspectives, because not one branch of analysis is right all the time. And one of the things that we like to do, everybody's trying to outperform their benchmarks, but one of the things we're trying to do is identify risks. And for me, I'm trying to identify risks more down the road about where our allocation might be going, how things might change, so clients get a little bit of a heads up as to where the potential risks and rewards are. So it's really to try to guide institutions and investment managers to have success over the long term.
So there's a couple of interesting ideas there about the framework with 4 pillars and this 360-degree approach of trying to look at things from multiple angles that I want to ask you about a little bit more later on. But before we get to that, in the conversation so far, Ned has come up a few times in terms of the history of Ned Davis. Obviously, the firm is named after him. I believe Ned has 9 rules on how to approach markets. I know a big part of what you and the firm do. Would you be able to tell us what these rules are? I know Tim started us off with 1, which was don't fight the tape. Perhaps you can talk a little bit more about that and the other 8.
Well, I'll talk about 2 of them, and then I'll maybe let you guys continue on with it. The second one, which Joe kind of alluded to, was beware of the crowded extremes, which is to understand if sentiment gets very one-sided. Then we have to start thinking contrarian. We don't act until the tape actually starts to move in the opposite direction, but it's more of a warning sign, and it applies to sentiment indicators. Are useful for this, as well as valuation indicators, which essentially are very long-term sentiment indicators. When things get look extremely expensive, we have to wonder how much of the good news is already priced in. The third is don't fight the Fed, which is basically be on the right side of monetary policy. This was extremely important to us back in 2008, 2009, when we had what I would call policy capitulation, when central banks around the world finally all got on the same page and started providing that necessary liquidity to start a secular bull market in stocks. And we're going to think about that in the future. If the secular bull market is going to be threatened, then we may very well start to see increasing evidence of tightening. So don't fight the Fed is the third one. And so maybe we have 6 more, so maybe I'll pass it on.
The fourth one is to rely on objective indicators. And, nobody's going to come out and say, I'm not objective, I'm subjective. But I think we do that very well, in that any argument or case that we're going to make, we're going to have a quantitative backing behind it. And we have our own software system that we've written internally because there was nothing on the street that could do what we wanted to do. And so we can use that to look back at cases historically and to determine this is how the market usually acts when you're in this scenario. And then when you do that, not just on one thing like the Fed, but you do that based on where valuations are. You do that based on where sentiment is and where the market breadth is at the moment. You get that really good objective view. The fifth one is to be disciplined. Again, it sounds easy, but when you're in the middle of it, it's not. And that could be when sentiment gets extreme. When do you start listening to that? When your indicators tell you to. And on the other side, when things start to get better, do you try to jump in and catch a falling knife, or do you wait for the indicators to tell you that the risk has dissipated enough that it's time to get back in, rather than try to be the hero and catch the bottom? You wait for the point when the risk is dissipated, and you can catch the big move. And the sixth one is again related to that. Practice risk management. And this really gets down to managing a portfolio, not letting, make sure you're diversified. That can be from an asset allocation standpoint. That can be for equities, whatever have you. Making sure that you have a disciplined approach to your portfolio.
I'm glad that Tim kind of amended the first couple of rules about don't fight the tape. I mean, it's really about, don't fight the momentum of the market and the trends in the market. I'd be hard pressed to know if a lot of younger investors even know what we mean by the tape. It's kind of out of date concept. And Tim also mentioned, the second rule about don't fight the Fed. And again, I'm glad, Tim talked about this. I consider it much more broadly now as, don't fight central bank policy and monetary conditions and financial conditions. So I think those are important. I'll take the last 3, and I've added a 10th one for myself. But number 7 would be remain flexible. And I think this is a really critical point, because you can really get ingrained to a view. And you hear it with a lot of strategists. They're become known as perma bulls or perma bears. And that really doesn't help your clients. You got to know when to get off a trend and when the trend is changing and when something is being fully priced into the market. So I think remaining flexible, certainly from that standpoint of, looking at the market and the environment and the data. But I think there's also another aspect to remaining flexible, and that's the fact that there are new ways of looking at things, new techniques, new data, and you have to be open to incorporating new data, new techniques into your modeling. And I think that's something that, again, we try to do here. We've incorporated new techniques over the years. I don't think any of us would have used Black Litterman or even knew what it was when we first walked in the door, but that's where the market went, to be using different types of data sets on volatility. That's just something we wouldn't have started, wouldn't have incorporated back when we started. So there are, quite a few things that are different. The money management rules. I mean, we talked about this earlier about being humble and flexible, letting your profits run and cutting your losses short. I mean, this is all part of the money management rules. But one that I like to look at that I think is very relevant, where you can see this in practice quite a few times, particularly on a shorter term basis, is buy the rumor, sell the news. So people anticipate an event happening, and when the event finally happens, it's all done. So we saw this pretty much in, just give a more recent example, but when the tax bill got passed in late 2017, there was so much anticipation of that, and shortly thereafter, 3 or 4 weeks out after, it was pretty much all priced in the market and done, and then the market kind of reversed after that. So it's important to sort of understand what is being priced into the market. And then the ninth one, which I think is also good, is those who do not study history are condemned to repeat its mistakes. Now, history doesn't repeat in exactly the same way. We like to say, history rhymes, but at least it gives you an objective sounding board as to what the market has done given a certain set of circumstances. There may be conditions that are different that override it, but at least you have to understand what the historical percentages are, and that's important. I add on a 10th one, and I think it doesn't happen that frequently, but when it does, it can be really powerful. And that's it's kind of the corollary to rule number 2, which is don't fight, the Fed or monetary policy. And my 10th one is don't fight fiscal policy. And when you have things like TARP coming in, where you literally stop a meltdown, that was a significant event. So things like that, to me, I think is important. And we can even see this going back to the 1960s, going into the Guns and Butter program. There are times where fiscal policy has a significant influence in the markets. It's not something you can use every day necessarily in your modeling, but when it happens, it's usually worth paying attention to.
There's a couple of interesting things I picked up on in your response, Joe, and I wanted to ask you about that belief around flexibility, because one of the things I've always found a little bit challenging is for somebody who tries to think flexibly is that other people think you're being inconsistent, because you've had a view on a market or an asset class, and now you're changing that view, and the natural reaction is sometimes, well, do you actually know what you're doing? You're changing your mind all the time. How do you deal with that issue of remaining flexible but not appearing to your clients as being inconsistent?
Yeah, I think it's a really good point, Dan, and it's one that's not easy to deal with, but let me give you a couple of real life examples. So back in the financial crisis of 2008, again, I focused on fixed income, and I was looking at the high yield market. And so you have to look for extremes. And I remember writing in my publication that would you rather get 2% a year in treasuries or 2% a month in high yield? That's how much was being priced in. There was so much default risk being priced into the high yield market at that time that, yes, I guess it could have always gotten worse, but you have to start saying at some point, all those things that were being put in place in terms of what the Fed was doing and starting to buy securities and doing quantitative easing, and what the government had been doing in terms of TARP, that these were going to start making a difference, and that we had reached a sort of logical extreme on that. And I think, the beware the crowd of extremes, yes, so you want to sort of think about going the other way. That to me was a time of thinking about going the other way. And then it's not just so much to see, the reversal of that extreme. Sometimes we use some sentiment indicators. But what's important is to start to see the reversal in trend, in price. So when those spreads start to come in the case of high yield, and those yields start to fall, then you're getting validation. And that's the real key. And then the second other example that I wanted to bring up, we had done a lot of work in housing in 2000s and getting quite cautious about the housing outlook in mid-2000, 2005, 2006, started getting more negative in 2007. And a lot of people will say they called the housing market crash. And I like to think that we did too, but I'm actually more proud of getting back in 2009 and 10 and not just staying permanently bearish on housing. And a lot of people stayed permanently bearish. And you just have to see, like, when housing starts drop to, ridiculously low levels, and when we had, housing investment running below, rates of commercial real estate, and that gap was like the narrowest it had ever been in history, that's telling you that we're at an extreme and that we need to start looking the other way. So a lot of people will say they call it the housing market. What they won't tell you is when they got back in, because some of them never got back in.
And in response to your question, that it's really, as a concept, it's the way NDR approaches indicators and data is that it's more of a transitional process. And I often say that the more confirmation you have from your indicators, and again, especially from this sort of 360 approach where you see it in your tape indicators, you see it in your monetary indicators, you see it in your economic indicators, and the more confirmation you have, the more conviction you can have. And the more conviction you have, the more decisive you can be in changing your position, changing your allocation. So there's a lot of times you get into these sort of transitional phases where we may be very bullish, and then we start to see the risks, the indicators start to look more mixed, things start to enter the picture, starts to raise flags. Many times, it turns out it was some sort of a consolidation phase, and you relieve the sentiment, and then the market keeps on going on the upside, and then you can just sort of reassert your bullishness. But I think that what that process does is that we don't end up, to your point, you don't want to go from bullish to bearish and sort of being seen as being sort of, overly responsive to the market or starting to appear maybe wishy-washy. I think the point is that it gets back to sort of this catch the major moves objective, and you can do that. I often say, if you're going to catch the major moves, you're going to not catch the absolute bottom. You're not going to catch the absolute top. But I'd rather leave a little bit on the table coming off a bottom, and I'd rather be a little bit late at the top, but then make sure I get those big gains on the big uptrends, and I'm avoiding those big losses on the downtrend. So I think that's why we ended up, we tend to be, in that sense, a little bit longer term. We tend to catch those major cycles, and so I think that's how I don't think are seen. My perception from clients is we're not seen as perma anything. We're seen as flexible, and that process I think allows us to maintain that.
Yeah, I wanted to follow up on one quick thing because I remember back into, I was talking about 2008 in December with the high yield market, but what was going on at that time in Tim's world is Tim was starting to see some improvement from a number of sectors. And Tim actually increased his equity allocation in December because he was maximum underweight equities for quite a period of time, from I think mid-2007 to late 2008. And so when I'm saying, Tim is starting to see some evidence that things are bottoming out, and then I saw this extreme in my world of credit that gave me some more confidence that things are starting to incrementally get better. And I think that's a really important point, is that we don't have to go all in or all out. You can move in increments, and that's okay, because it's a probability game. It's not all in, all out. It's not 100% and zero. It's not black and white. Investing is never black and white. There's always shades of gray. And we're trying to align with the weight of the evidence, the preponderance of the evidence.
When we're writing our research reports, we're always setting up the next move. So we say, okay, now I favor growth over value. But then, well, what are the things we're watching for that next transition? And then you monitor those. So when you do make that transition, for those who are reading you on a regular basis or talking to you on a regular basis, it's not a surprise. It gets back to the approach, which is just have your objective indicators And so if you're forward looking with those, then you shouldn't come off as wishy-washy. We're not shock jocks here. We're not trying to have the maximum effect of the call. We're trying to have the maximum effect on our clients' portfolios.
You're actively trying to identify the reasons that your view would change, instead of just this, here's the view, but also, here's the 3, 4, 5, however many things we're looking at that would cause us to change. I think that that's a very important discipline in investing, to look at the other side of the trade.
And, the other aspect of this is I try to understand the relationships between markets and how they're changing. And, for example, right now, I'm paying attention to what Joe is saying, because I know that there's still a positive correlation between bond yields and stock prices. So I ask the question, what is the bond market telling us? So one of two things is going to happen. Either the correlation changes, in which case we're sort of back into another environment, like we had back in the, back in the 80s and 90s, and even before that, bond yields will go up and stocks will go down. Well, since then, it's been the opposite. Bond yields go up, stocks go up with them. So, right now it's relevant because if bonds, and, we just had a discussion about this Monday, and I said, I'm paying attention to the bond market because that will be if Joe starts to see, signs of a bond yield uptrend going again, I'm going to use that as a stock market indicator. In this case, because you have that positive correlation, I would say it's a sign, well, maybe the global economy, U.S. and global economies are, in fact, starting to gain some traction, and therefore maybe the stock market has been correct here about anticipating that earnings are going to come through and that valuations are therefore justified, and that, we're back into an upcycle. So, we can use these different markets as indicators in our various areas. But yeah, I'd say that's something to always understand, the relationships between markets, because they evolve over time. And from a secular standpoint, one of the, I think, longer term developments is, nobody, I'll defer to Joe on the inflation outlook as well, because if we get back into an inflationary environment at some point in the future and we start to see inflation expectations pick up, I'd be paying attention to those correlations, because the stock market may start reacting a little bit differently to rising bond yields. And that would have a very negative impact on the secular outlook, because then you start to question relative valuations. You start to question, if we're back into an environment maybe similar to the late 60s and that sort of thing. So I think it's really another aspect of looking at the markets, is to really understand these relationships. And I do that by paying a lot of attention to correlations. And you'll see that in our service, we have a lot of reports that kind of try to understand if their correlations are changing, if they're stable. Some correlations sometimes there's no correlation. Sometimes, things change over the short term, but then you look in the longer term isn't changing. So, this is another aspect of looking at the markets.
I think it was also interesting when Joe was talking about the study of history, because one of the things reading Ned Davis's research that's always impressed me is this focus on publishing base rates for things. And I know when I was allocating assets at a pension fund, it was very hard to get good quality base rate information on whether it's a particular factor or a particular indicator, sort of what it's done over time, and what to expect when things when that variable is in a certain range. Has that always been a part of the process, this focus on base rates? And how do you use base rates?
Looking at historical relationships and historical conditions has always been a focus of NDR. In fact, in the 1990s, we made a major push on creating a bunch of studies of market history and looking at certain conditionalities. So, on the monetary side, for example, what has happened to markets after the first Fed rate cut? And how has the performance of the markets been after that, looking out 3, 6, 9, 12 months later? So yield curve has been popular recently. What's happened to the economy? What's happened to the markets after the curve is inverted?
What has happened?
It depends on the portion of the curve that you're looking at. But in looking at it in economic terms, it wasn't an infallible indicator. I mean, it did make a couple of mistakes. It's been good recently, But it's important to know that and provide an objective check on what the media is telling you. And sometimes you will read either in the media or other people's analysis this relationship, and you look at it and it's like, wow, it's worked great over the last 2 years or 3 years or 5 years, and then you take it back 15 or 20 and it's like, this has no relationship at all. It's completely meaningless. It's kind of like what Tim was talking about before. The correlations change, and you have to understand why things are changing. And sometimes, by understanding history and studying history, you can blow up some myths. And that's really what we were trying to do. And sometimes we are known as mythbusters because, we just blow up, some common.
What are the worst ones, do you think?
The worst myths. I think this one about the yield curve was really one that I just haven't really taken a hold of, because there were several. We had many recessions prior to 1960 that were not preceded by yield curve inversions. So the yield curve isn't the only thing that you need to call a recession, although you listen to some people, you think that's all you need. And we've had false signals as well. We had false signal in 1966. We had a false signal in 1998. So it's not the be-all and end-all indicator. So that's one. I'm sure there's a ton of other examples.
I think a great example was in early 2008. And we were already in a recession. We pointed out at the time, we knew we were in a recession. And, then Bear Stearns went under, and it had all the characteristics of a bottom. And people were looking at the Fed model at the time, saying, wow, this is incredibly bullish. Look how cheap the market is. And again, the Fed model basically looks at relative valuation between bond yields and stock prices. And the thing about the Fed model is that it didn't go back to the 1930s. But what was happening in 2008, the whole 0709 period was a period we hadn't seen since the 1930s. We hadn't had that kind of deflationary pressure, and the stock market, therefore, was not going to benefit. It didn't matter how low bond yields were going to go or how cheap the market got. It was going to require some sort of massive policy response, which we finally got in 2008, 2009, to turn things around and get the economic outlook improving again. So I think that was like a major example of why, if you rely on one indicator, something that was widely touted, we don't hear about it much anymore. I haven't heard many people talking about the Fed model, but I think that was an example of how you have to be very careful about making assumptions based on something that was developed over a limited time frame. And I remember at the time, really the two indicators that really helped in 2008, one was credit spreads, because we had the Moody's bond yield to long-term bond yield spread, which had reached its highest levels since the early 1930s. And that gets back to what Joe was saying about credit. And then the other one was volatility. Market volatility had reached levels we had last seen in the 1930s. And, that was kind of a sentiment indicator because, again, you don't have a lot of data once you get back prior to the 1980s and 70s. But the one thing we do have is price data. So if you have price data, you can calculate realized volatility. You can look at what we call NDR volatility index, 100-day change volatility. And, we got to we'd never seen this. So these were kind of what Joe said in late 2008, we were starting to see signs that this was like the 1930s again, and potentially, therefore, probably at some kind of extreme. So, that was one example, in addition to the yield curve, that I would say is again, a warning why we have to be a little careful about, putting too much dependence on any one indicator.
Yeah, I think the other one that I run into a lot, particularly with newer clients, is the expectation that really good earnings growth is bullish, and historically it hasn't been, because by the time you get to good earnings growth, the market's already priced it in, and so in a situation where you get you're looking at earnings, I got 25% earnings growth for the S&P over the last year, the market's really humming, the economy's doing great. Well, then we start pricing in that slowdown. And on the opposite side, when earnings growth is pretty bad, minus 10% or so, that's when the market is probably priced in a lot of the bad news and things get better. So, so I think a lot of times people say, well, I don't want to look at technicals because I really study fundamentals, but they're really looking at fundamentals technically. They're the fund momentum of earnings rather than where earnings are going. And so that's another good one that in terms of myth busting.
When you look at measures of long-term valuation for most asset classes, and I'll pick an example from equities, the cyclically adjusted PE ratio, it's been showing that the equity market has been expensive for a very long time. I think we're at levels where only the tech bubble had a higher CAPE ratio. And a lot of people have been negative on the market because of that, saying at some point. What are they missing? Is it just another example of over-reliance on a single indicator? Or
first and foremost is you don't want to focus on one indicator, but I like the concept of cyclically adjusted PE ratio, but what it is you're looking at an inflation-adjusted 10-year average of earnings and then looking at price currently. Well, if you go back over time in the 40s, 50s, 60s, 70s, when that indicator had a great track record, over a 10-year window, you could have 2, maybe 3 recessions. So you're going to pick up several cycles, which is why it's a cyclically adjusted PE. But now, we're almost at a record high 10 years. So we're going to point in a few months where if we don't go into a recession, we will have a full 10-year window of CAPE without a recession. And so it's just not picking up what it was before. So we actually looked at about 25 different indicators, valuation indicators, and said which ones have done a good job consistently over time when you say look forward 5, 7, 10 years. And actually earnings do better than, say, dividends, book value, things like that. But if you average out a forward and a trailing, you tend to do better than even the CAPE. And the reason is, as we alluded to a little bit earlier, that analysts at the bottom of a recession, they're actually going to be bearish on earnings, and they're not going to forecast the recovery. So the E is looking really, really low. And so it's making the PE look artificially high. So a combination forward and trailing usually works better than the CAPE.
I remember earlier in our conversation, Ed, you mentioned the 4 pillars of NDR's research framework, and they were the macro, the fundamental, the technical, and the sentiment. I was wondering if each of you can give me an example of how those 4 pillars work together in the areas that you look at. Perhaps we'll start with Tim. When you look at that 4-pillar framework, how do you see the world at the moment?
Well, right now it's very interesting condition we're in. Let's start with technical. We've had this rally over the last. It really went from January to March. The market right now, so you've got a lot of the short-term indicators got very bullish. The longer-term indicators, and we spend a lot of time looking at breadth and looking at indicators based on 200 days. Well, those have been more mixed. They have not broadly confirmed, especially when we look at things like percentage of markets with rising 200-day moving averages. Only about a third of markets around the world are actually back into uptrends. We try to aggregate a lot of these indicators in what we call a rally watch report, which on average has gotten up to around 80%. After market bottoms, it's backed off. It's now at 37%. So clearly the technicals had a nice push short term. I often think about 50-day indicators as sort of being a good measure of sentiment driving the market. Maybe the 200-day indicators may be more a good reflection of the fundamentals, or the fundamentals really confirming. I'd say at this point in time, we've had that sentiment push, but the fundamentals, I think the jury's still out on that. And right now, we're sort of at a today I'm going to feature a chart of the percentage of markets above their 10-day moving averages, which has actually been very divergent and is falling off again. So I think what's needed here technically is we need to have sort of a reassertion. When we get these what we call breadth thrust indicators, we have 5 of them in our rally watch, and that buys you about 3 months. And some of those indicators have started to expire. So what that's telling us is we need to have another push here technically. So, and then let's think about sentiment. So we had this burst of performance to start the year. And it brought a lot of our sentiment indicators very quickly to excessive optimism. We have a global sentiment composite, which is showing the most optimism over the whole history of the data, going back to the 1970s. We're seeing this in one of Ed's indicators in the U.S. service. The crowd sentiment poll had gotten to its highest level since October. The market's gotten very concentrated. We've also gotten to about more than 12%. Top 10 stocks account for more than 12% of the market cap in the All Country World Index. So it's gotten very concentrated and very narrow, lots of optimism. And so then the question becomes, if we then ask the question, well, is actually this just a pause, and actually the market has already correctly anticipated that earnings and economic growth are going to come through. We have, then we turn our attention to the economic data, which has started to look a little bit better, but it's probably a little bit too early to confirm that in fact we've bottomed and globally things are coming back. And clearly we've had the Fed go on hold. I'll defer to Joe on the question of monetary policy, but have we had China has tried to get things started again by they were sort of on this had this movement to bring down their debt levels, but they've seemed to have backed off on that and starting to be a little bit more accommodative. Will the Fed actually become more accommodative rather than just sort of pushing things down the road and delaying their eventual accommodation? So that remains open. So I think the overall assessment is that I think near term there seems to be a lot of risk. Longer term, maybe things are getting better, but I'd say I'd be a little cautious to commit new money to the market right now until we get some kind of correction that brings the sentiment down to more realistic levels.
This is probably the biggest divergence, at least in the past 8 years, between what Tim's seen globally and what I'm seeing in the U.S. So when somebody says, well, what worries you? I say, well, what Tim's saying. Because he's not wrong. I mean, the global technical picture is not as positive as you'd like it to be a few months after a bottom. But the U.S. technical picture has improved much more. We did get very powerful breadth thrust signals. In fact, December 26th was a 188 to 1 update. That is, if you take all the volume of stocks that went up on the day, and then you compare it to all the volume of stocks that were down in the day, is 188 times more for the up stocks. And that is the highest in our database. It goes back to 1980. And if you compare that to NYSE data, going back to the 30s, there were a couple times in the 30s that were higher, but that's it. And then we got a couple more of those, in particular on January 4th. That was when we got the jobs report, and Powell made a very clear pivot to being more dovish. So you got very powerful breadth thrust signals, and then you have gotten more confirmation on longer term indicators. Big Mo tape, which is really a breadth indicator of sub-industries. I'll contrast it with what happened in 2015 and 16, where you got a decline into August of 15, China devalued, and then the market bounced, and Big Mo tape rebounded from the 40s into the 60s. 60s is a pretty good percentage of sub-industries and uptrends, but then it fizzled. And by the time we got into later in the end of 2015, it had completely rolled over. Beginning in 2016 was when the worst starts to the markets in history. That Big Mo tape fell to a new low, and then off the February low, you got a much better rebound in Big Mo tape. It followed through more soundly, got up into the 80s. And so what's happened since the December low in 2018 is that we have gotten Big Mo tape, actually did get, I think 79.9. So much better than, say, what we had in that false rally in late 15. But I would say Tim is absolutely correct. The sentiment indicators have shown some optimism. So the fact we've had a very strong move, 20% in the S&P, it wouldn't be surprising if we get a pause. In fact, usually even after breadth thrust, you do get a correction, average around 8% before now. So we haven't gotten that yet, and so you want to see what it looks like once you get that pullback. Is it healthy? Do you have a very few divergences in terms of stocks making new lows, or do you get a lot of expanding new lows? The fundamental picture is one that has been talked about. Things can be a little bit different each cycle. The tax cuts really threw things off. The rest of the world in 2018 had a slowdown in earnings. The U.S. did not because of tax cuts. Now we're getting the slowdown, and it's a question of, is this just the fact that year-to-year comparisons are too hard because the tax cuts had such strong growth in 2018? If that's the case, we end up with low single-digit earnings growth for 2019. That should be fine. And historically, what the decline we got last year of about 20% in the S&P, that's about what you get when you get an earnings slowdown. If it's a more severe one and you actually have a severe earnings recession, it's a totally different ball game. But I think the biggest change, this may be a chance to hand it over to Joe, is the Fed pivot in early 2019 took the Fed from being fairly hawkish to being a big tailwind for the U.S. markets. And so you put that in balance, and again, we'll look at the weight of the evidence, but right now the U.S. stuff doesn't look that bad.
I guess when I approach fixed income, I try to use a top-down framework. I try to start with the macro, what's going on in the economy, what's going on in inflation. And clearly, when we looked at what was happening globally, we were in the middle of a global slowdown. Now, at some point, the markets price that in and the central banks react to the signs of weakness. So what I then look for is, okay, so this is widely recognized when you have the IMF cutting their economic forecasts, and it's pretty well known that the global economy is slowing down. Then you start looking for signs that it's going to be bottoming out or improving, and we started seeing a few of those signs, and some signs that stimulus from China is coming through. We're seeing some signs in the U.S. that the U.S. economy is holding up relatively well. Retail sales seem to be coming back. Housing seems to be coming back. So job market remains tight. Unemployment claims continue to make new lows. So there are a few things that we need to look at now, because we have to look forward. I think one of the changes that's happened over the years, when we got started and data was hard to come by, and the pervasiveness of powerful computing power in your hand or on your desktop wasn't really there. You could look at rates of change, momentum. That's insufficient now. Now you have to look at the second derivatives, as people like to refer to it too, is the change of the change. You're really trying to anticipate how that momentum is beginning to change, because that's what the market starts pricing in. So that's one area. Inflation has been quite subdued. I think there are some potential short-term risks around that, but I think the structural case for inflation being low is pretty well intact, and particularly outside the U.S. and in Europe and Japan. I think it's going to be a long time before they can get inflation toward their 2% inflation targets. Then, we talk fundamentally, you talk about the central banks. The Fed, as Ed mentioned, was key among them in pivoting and basically going into a patient mode, a wait and see mode. And every major central bank is basically following the same playbook. The ECB basically is doing that, actually trying to ease some conditions with some new TLTROs. Obviously, the PBOC was easing monetary conditions. Bank of England's on hold. The Bank of Canada's on hold. The RBA is on hold. I mean, it's just pervasive that, if the central banks have your back, I mean, there's probably going to be a limited amount of backup in yields until we start getting some clearer evidence. The valuations, however, probably pretty fair. So I can't really say that, the market hasn't really recognized this. So we're actually looking at things being in a trading range. Now, the technical picture looks a little more interesting. So short term, things have turned down a little bit, but over the intermediate to long term, they're still quite favorable. So this is also sort of understanding what time horizon you're operating under. I think that really determines, your outlook. So we try to gear for an intermediate to longer term outlook here. We're not day traders, but we have clients that are. So, having an understanding or appreciation of where the market is, short, intermediate, and longer term, I think is really important. Another thing that's been a little bit more on the positive side is the supply-demand balance in bonds. There really has been a shortage of high-quality debt. You look in Europe, with Germany running budget surpluses, they certainly don't need to issue a lot of debt, and so there just isn't a lot of sort of riskless type of debt that's available for investors. So that's adding to a little bit better technical tone in the market. And sentiment, I would gauge it, neutral. And then again, you can look at sentiment in a couple of different ways: the absolute level of sentiment or relative sentiment. So things might be looking relatively extreme in terms of optimism, but compared to the full history, it might be just sort of in the middle of the road. So again, that sort of helps to understand, what's your time frame? Are you a short-term trader, or you have a longer-term view? So understanding the context of these indicators, I think, can be helpful. So this isn't the most exciting time in the bond market because of what the central banks have done and the behavior of bonds, over the last 6 months. And so, neutral is not the most exciting thing in the world, but sometimes it's the right call. And that might not be popular with the press, but, we're really not interested in making a headline. We're interested in trying to keep clients on the right side of the market moves. And if things aren't always clear, taking a more neutral stance is the appropriate one.
I've noticed as we've been talking, this idea of trend keeps coming up in one form or another. Is trend or momentum just a fancy word for market timing? How is looking at trends different to, say, other forms of what people commonly associate with market timing, say looking at chart patterns and things like that?
Trend is really when we talk about, I mentioned this earlier about confirmation, is that some trends are stronger than others. I mean, Joe mentioned, bonds are in neutral trend. Sometimes you get into these trading ranges, but trend is it's more about getting on the right side of the mood. Timing, I would say, is how timing comes into it is combining trend and sentiment. Is that sentiment tells you when you're vulnerable or you have the potential for a trend change. So we often say you get ready for the trend change. And then you start to see your indicators start to roll over, and then they start to confirm in the other direction. And then you can have, as I said, the more confirmation you have, the more conviction you can have that the trend has changed. And so you start to see, well, then you look at your indicators and you see, well, we had gotten to excessive optimism, excessive overvaluation. Then the trend we had divergences that typically happens at the top. We could be seeing this now. You start to see non-confirmations. Then you start to get things confirmed in the other direction. And then when you get that confirmation, you look back and say, well, we're confirming the other direction, having already reached an extreme in sentiment with the potential to go to that other extreme in sentiment. So to go from here, where you get the trend confirmation, to back down to the other extreme in sentiment, that's where you're going to have your major move. So that's how I would think about trend. It's really a word that encompasses participation across markets.
One other difference is that I think people think of that and they may jump to chart reading. I don't think anybody here has ever written about a descending triangle in the research reports. And Tim's pretty humble, but he may not tell you that he's a Charles Dow Award winner, which is the highest award in technical analysis, right? But it was basically illustrating what he just talked about, which is different from what a lot of people think of. They think momentum, but so it's much more objective than that, and I think that's where a lot of people really love NDR. It's taken something that had been somewhat subjective and chart reading, technical analysis, and turning it into something much more quantifiable and objective.
It's a really important concept. And let me give you a great example as to why you need to pay attention to the trend. So if you give any modeler, econometrician, data, they can build you a darn good, if not perfect model of what's happened over the last 2 years or 5 years. The problem is when you get into a different situation. So you go into the post-financial crisis, we didn't have experience with QE. How are we supposed to model that? There isn't a good historical analog. So by analyzing the trend, you can capture what you can't explicitly model. And that becomes a catch-all for things that are going on in the market that you are either unaware of, don't have data to accurately capture, or just something new and different that you need to factor into your thinking. And that, to me, is the benefit of trend. And that's why people who get hung up on certain indicators miss out that the market is no longer focusing on that indicator, it's now on something else. And the trend helps get you to where other people are thinking, even if it's not where the majority is.
That's really interesting. I've never heard it described that way, but it makes a lot of sense what you're saying. So I think back to a lot of the academic research on, let's call it market timing, says that it doesn't work, for example. And I'm going back to the one of the very first papers, which I have a lot of problems with this from a research perspective, but you've got William Sharp's paper, The Likely Gains from Market Timing, where I think the problem with this was kind of the way the question was structured. So he looked at, it's January 1st and you have to decide whether you're 100% in the market or 100% out. I don't think anybody does that. You have to be right 80% of the time to break even trying to do that, so therefore market timing doesn't work. Now, I know what you're trying to do here is very different in that, as we said, there's sort of this transitional aspect to it, and moves are often gradual, but can market timing or trend analysis or tactical analysis, whatever you want to call it, can it work, and what does it need? What do you need to do to get it to work?
I think that alludes to one of the challenges in the marketplace, is that if a group says we're only going to make a change once a year, and that could be a pension fund, it could be an advisor sitting down with his or her clients, it does make it difficult. And that's where our models come into play. We say, well, right now we're bullish or bearish, but people say, well, when are you going to change? What's your time horizon? My time horizon is, well, on average, these moves tend to last 9 to 12 months, but I'll change when the indicators tell me to. And that could be in 3 months, and it could be in 3 years. But to say I'm only going to look at it on this date once a year, maybe you shouldn't be trying to market time that much, because it is a tough gig. But if you remain flexible and disciplined, and then when the information changes, you have a system in place where you can make those adjustments, then you can outperform.
I think it also speaks to a topic I know Dan and I agree on, which is the value of asset allocation. Is that, if you have, just this year was an example. I mean, I've been overweight bonds and I've been underweight equities. Well, what happened? Bond yields came down, and the bond performance in March offset continued strength of equities. So it just shows you, if you have a diversified portfolio, asset classes, you'll get these offsets. And so you don't lose money that way. And again, it gets kind of back to this idea of, the big money's made on the big moves, and you want to. So I think part of the issue here is, when we talk about, do you want to be in or out? If you're not in, where are you? And there's other options, commodities, gold, real estate, whatever. But anyway, that would be one thing to keep in mind in addressing that question.
The time period that study was performed over can be really critical in assessing the value of making allocation shifts, or if you want to call it market timing, then do that. But the value in market timing or allocation shifts is a downside strategy. You avoid the big negatives on the downside. So it's hard to outperform buy and hold when the market's going straight up. The performance comes in when the market goes down. And when you're out, and it's interesting, right? You mentioned Bill Sharp. I mean, if you look at Sharp ratios, you will see a smoother return stream because we don't have the downside that he's going to capture by saying there's no value in market timing. So when you look at risk-adjusted returns, I think you're going to end up with a better, stream and better results because we're cutting out the downside. And that is, I think, an important aspect of what we do. It's not just about the return, it's about the return relative to the risk that you're taking. So as Tim was talking about just a minute ago, you're trying to capture the big part of the move. Well, if you're in equities and because equities are going up and then they start going down and then you switch into cash or gold or something else, you can be gaining the returns from those assets. And you miss the whole downside on the equities. So that gives you a much smoother return profile with a lot less risk. And at the end of the day, that's what most clients really care about.
It's interesting. I was chatting with Tim when we were at the Ned Davis conference in Boston about a Ned Davis chart that shows the 30-year, and I think similar chart even for the 20-year returns for stocks and bonds that I think was around about 2010, they converged. So what that tells me is if over the 20 years up to that period, you had whatever your allocation was between stocks and bonds, buy and hold, you got largely to the same place. And I think there's a whole generation of investors and allocators that have kind of been conditioned for that environment that whatever the mix of stocks and bonds, if you buy and hold, it'll be okay. But if you look at that, the relative returns over those sorts of periods going back in history, convergence is the anomaly. It's not the norm. And so the question that everybody's got to think about is, what happens if these asset classes start behaving differently again? And I know Tim talks a lot about the correlations. What if you're not getting the correlation benefits between them that you've been accustomed to for the last 20 years? And there's some big questions here that I think a lot of people need to think about.
Starting in the early 1980s, we were in a secular bull in bonds and a secular bull in stocks, and you had an inverse correlation. So more often than not, bond yields are falling, stocks go up. Then we get to the 2000s, we get into the bubble, the deflationary worries. Bonds are still in a secular bull, equities are in a secular bear, correlation flips. No longer are people worried about rising yields. They see rising yields as a sign of growth, and they see falling yields as a sign of deflationary pressures. Signs of deflationary shows up, stocks go down. This continues until we get to 08, 09, and finally you get that policy capitulation. This reflation of the global economy gets started, and we still have this relationship of bond yields going up and stocks going up because the market cheers signs of inflation. We have inflation targets, as Joe mentioned. The markets want to see inflation. When they see it, they rally. Bond yields go up, stocks go up with it. This has continued to define the environment, but at some point in time, what happens when yields finally, let's say the 10-year Treasury finally breaks well above 3%, maybe it gets to 4%, 5%. At some point in time, if it is in fact driven by inflation expectations, my concern is that at some point in time, the stock market is going to start to see a negative side to rising inflation and interest rates, and the environment starts to look a lot like the 60s again, 1970s, the stagflationary environment. Then you have a worry that if bond yields are breaking out, and Joe makes the call that we're in a secular bear in bonds, and if we're in a secular bear in bonds, bond yields are in a long-term uptrend, and you see that correlation invert again, then we have a real problem. Because then, unlike the 80s, when you were in a secular bull in stocks and secular bull in bonds, you're in a secular bear in bonds, and the inverse correlation persists, and that's the setup for a secular bear in stocks. So what do you do in that environment? Well, remember what happened in the 1970s. The place to go was gold and commodities in general, hard assets, real assets. And it's an entirely different investment environment than anybody in this business really can remember. So I think that's a really good point, is that we have to think about environments that we haven't even seen yet, but have existed in the past. And that's, again, goes back to why it really pays to look at long-term history, look at market history, look at relationships between markets, and think about the economic environment that was going on at the time. So yeah, I think that you make a very good point.
So Ned has actually written a book called Being Right or Making Money, and the title reminds me of a quote that I read in another great book called What I Learned Losing $1 Million, where the author says, do you have a profit motive or a profit motive? As in, are you trying to tell the future or make money? And I think both phrases kind of get at this idea of managing our behavior as investors is really important, because at the end of the day, we're trying to make money, but we all have this temptation, this need to be right at times. So how can investors train themselves to follow the evidence rather than personalize or internalize their investment decisions? What are some things you found helpful in terms of trying to focus more on being objective rather than being right?
I had a really good front seat in 2007, 2009. I was working with Tim at the time and watching him make that great call in 07 and making that great call again in 09, and Joe making that, when did you make that end of recession call? In July of 09? July of 09. Yeah, and it turns out June was the end. And then a couple years later, I'm trying to make those same making calls, and it is a lot harder when you're the one actually with your finger on the trigger. And, I'll tell you, we mentioned earlier mistakes. And the first couple of times I made a call on growth or value, I was wrong. And I had to go back and look, and what am I doing wrong? And I was looking at the trend, but I was waiting for the trend to completely line up. And by the time I got in, then a lot of the move had been made, and then I waited for the trend to roll over. And at that point, you'd actually lost more on the other side. And so that's where the objective weight of the evidence comes in, where you add on the sentiment, you add on the valuations and the macro, and so you can make those moves earlier than if just one of those things had lined up. So I think that's what it really comes down to is making sure you have that objective, disciplined strategy in place for making decisions. And then when it comes time to make the decision, it's already for it. Like I was reading a book on habits recently, and they talked about Michael Phelps and how did he win those 8 gold medals. And the reason was he had his daily routine at the Olympics had been set for months, if not over a year. He got up every morning, ate the same thing, listened to the same music on his headphones, exact same warm-up. By the time he got behind the blocks, it was done. Yeah, it was routine. And so when the markets are going crazy and you're trying to make heads and tails of it, go back to what you've already put in place and let the evidence present itself, and then you make the decision. And will it be right 100% of the time? Well, no, we're not. There's only one Michael Phelps, right, who's going to win all 8. But if you do that, you have a much better chance of being right over the long term.
It's sort of implicit in the 9 rules of research. But one thing that NDR has always steered away from doing is making forecasts. And we often say we forecast for fun. Ned's always said that. But we take the indicator seriously. And there's a really, really good reason for not forecasting, because and I'm always uncomfortable because clients are always asking us, we put out our outlooks for next year. They want to know what, they want to know, where's the S&P going to be a year from now? Where's gold going to be, whatever. But the point is, if you get in the habit of forecasting, which would be sort of one of those bad habits that Michael Phelps, would have not done. But if you get in the habit of forecasting, if you have so much data at your disposal, so many indicators, you can really support any case you want. And that what happens is you start, your brain starts to just so fixed on this idea that you're right, that you'll find support for your argument. And we have that, that's a real danger with our product, because we have so much information to go from. I mean, I could make a bullish or bearish case right now. I mean, I could say this market's going to, quadruple by the end of the year, or it's going to crash and go into a major depression. So, that's why I think we really you need to check your own expectations, and that helps you be flexible. And the other thing about it is you certainly don't want to start putting stuff in print that gets very decisive about where you think things are going, because then you have to go back and justify what you wrote about, and then you just start digging a hole for yourself. So, I think the way we like to do it, as Ed mentioned earlier, you sort of put out, this is what we're watching, if this happens and this happens, and this happens, will change the view, and it kind of gives you a roadmap. So you can go from being here to being there, and you don't get into this problem.
I like to do both. I want to be right and make money. I don't want it to be an either or. But I think Tim just mentioned it here, and what Ed just said earlier, what Ed had said earlier was really important. It's kind of knowing when you're wrong when you go into a trade. You could be a trader and say, I've got a stop loss. Regardless of what happens, I'm out. I mean, you have to know what to look for to exit when you enter a trade. And that's really hard for a lot of people. It's like, what can go wrong that would cause me to bail on this position? And the other important thing is we do more of an inductive look, right? We're looking at the indicators and then trying to see how those bubble up, rather than saying, I know because of this, that, and the other, this is how the market's going to behave. That can really get you into a trap. And that, again, that's the adherence to the discipline, adherence to the indicators, I think is important for keeping that open mind and keeping flexible. And that way you can adjust as the data changes and as the indicators change.
In 87, we had a conference, and Ned was speaking at the conference, and he shows up for his presentation and had on a green tie, and he gave a very bullish presentation. And then Ned said, wait, I brought the wrong tie. He goes back, puts on a red tie, and gives a bearish presentation. And I thought that was a really classic way of sort of demonstrating how you can support any argument.
Another theme that's come up a few times in our conversation has been this theme about the inevitability of mistakes. And that's something that I think a lot about, because when I think about investing, I define investing as decision-making in the face of uncertainty with incomplete information, and the results of which sometimes you won't know for a very long time. And to me, mistakes are just naturally, therefore, part of the territory. So the whole idea of constructing a portfolio is ensuring that you survive your mistakes. And you talked a lot about how Ned is very open with the fact that he's going to make mistakes, you're going to make mistakes. Unfortunately, not everybody out there has such an understanding boss that is going to say, well, mistakes are going to be made. So how do investors learn to get more comfortable with the mistakes, and how do they come up with a research and investment process that allows their portfolio to survive those mistakes?
We want to avoid the major moves on the downside. We don't want to make the big mistakes. I tolerate small mistakes, but not big ones.
I think it's important to understand what is a mistake. A mistake can be different things to different people. If you're trading and or if you're day trading, you're not going to be able to catch every single move, and that's just you better be able to accept mistakes. If you've got a long-term time horizon, making a mistake could be catastrophic. So I think it helps to understand what a mistake is and whether you can be suited to take those kinds of mistakes. There are probably some people who should not be investing and should leave it to professionals because they don't have the mental tolerance, right? It's a big psychological game in some respects. And that's just not suited for everyone to do. And then I think, mistakes come with the territory, just like with anything else. You get better usually, but I think in most cases you get better with experience and practice and doing it. And you see what works and what doesn't work. I mean, there were a lot of people who thought they were geniuses day trading tech stocks in 1999 and 2000. And then you didn't hear about them after that. So, I think it's important to kind of know what your limitations are, what you're good at and what you're not good at. And, just realize that there just maybe take some time, maybe a runway before you can gather enough experience and practice to be able to, put these things into place. And there are, there's also the size factor. If we're playing around with $1,000, option trade or whatever. Okay, so we make a mistake. It's maybe not that big a deal. You start applying that to $1 million or $2 million trades, and all of a sudden, like, whoa, I better be right on this. So that's another psychological hurdle that, it's harder to get over, but you have to get through it through practice. And again, if you don't feel you're capable of doing that, then you probably should rely on somebody else to do it for you.
I keep hearing a lot from prominent investors. For example, there was a great interview with Stan Druckenmiller where there's comments along the lines of, we've had all this unprecedented intervention in the market, whether it be by central banks. And then another comment that comes up a lot is the rise of algorithmic trading and the way that's impacted the market. And I know Ned has written extensively on buybacks and the role that they've played, particularly in the US. I'm just interested, if I've given you 3 examples, there's probably others, but do you think these things have impacted the way your analysis works? Because listening to Druckenmiller, he was saying that a lot of the things he relied on don't seem to work so well anymore.
I get that the problem is that you don't want to be too quick to dismiss what the indicators are telling you. Because I'm like, if I wanted to dismiss the breadth thrust indicators, I would say, well, it's all because of algos, therefore it's giving us a false signal. I don't know that. We know that there are changes in the industry that are going on. We know there's more of these quantitative programs and so on. We know that there's black pool, dark pools where, a lot of trading takes place. It doesn't have to be recorded. We know, the ETF world has changed things dramatically, and the potential for, when there's redemptions of an ETF, they have to go and sell all the stocks, or vice versa. So people go in an ETF, they buy all the stocks. So what has this done with, I think we can look at a few things, correlations across stocks. I talk a lot about correlations. I think we can look at sort of how it shows up maybe in volatility, the fact that we've had very low levels of volatility. But I think we have to be a little cautious about dismissing things. And I'll let Ed talk about buybacks, but that certainly has been sort of an ongoing, and I don't think it's anything new when we think about it from a secular standpoint. We've had this whole buyback trend. We have charts showing it's been a constant condition since the secular bull started 10 years ago. So I guess what I'm saying is I think we need to understand these influences, but don't be too quick to say that they're distorting the indicators unless we have really solid evidence to say that, because there have been cases historically. For example, short interest is something we used to use as a contrarian indicator. When there was a lot of short interest, that's usually a sign of excessive pessimism, and it's often a buy signal. Well, it turned out that it started to become more structural. Short interest was no longer really as much of a sentiment indicator, it's just part of the market. So we started removing it from our models. It just wasn't as useful, and so I guess there is an element of these things affecting how you're looking at things, but we also don't want to be too quick to use it to dismiss indicators that currently exist. So,
an example of something that is just different now. When I got started, I would collect the odd lot data. So that is, if there was less than 100 shares traded in a stock, that information was collected by the exchanges, and that was a sign of kind of non-professional investing, that it could be a sentiment indicator, because if you didn't have enough money to buy 100 shares, then maybe you weren't as astute. So if there's a lot of odd lot trading, that could be optimism. And in fact, actually, I would call Ned, when I was at J.C. Bradford, I'd call Ned up every day with the odd lot data, and that's who I knew Ned Davis first, the odd lot guy, not knowing he was this great mind in investing. But now that doesn't matter because of ETFs. They're buying and selling all these different numbers of shares. The odd lot data is not important in that way. But as Tim mentioned with buybacks, it has been a growing influence. And there's a study recently showing that, buybacks represented a huge percentage of buying over the last couple of years. But look, for every buyer, there's a seller. So if companies are buying back their own stock, by definition, somebody else is selling it to them, right? So to say, all these people are selling, well, yes and no. What's their allocation? Well, they're still they still have a healthy allocation into stocks. If you look at surveys of individual investors, their asset allocation into equities is still very high. So it's not like, they're particularly bearish. So I think it's kind of a static way to look at it. But it is important to constantly be evaluating the why behind some of these indicators to see, okay, is this still the same rationale that it was before? One more example was, some of the interest rate indicators that we had built based on the 80s and 90s, because Tim had talked about the correlations, they acted a little bit differently. So we've actually taken some of them out of models. We still have them in there, but maybe they're not as influential.
There was an analogy, a saying that was popular, and I think Marty Zweig and then Ned used it: 3 steps and stumble, and 2 tumbles and a jump. Well, certainly in the 1990s, 3 steps and a stumble worked, but when we got to 2008, there was a tumble, and then there were 2 tumbles, and there were 3 tumbles, and 4 tumbles, and I don't know how many rate cuts did we end up getting at the end of it, and the market didn't jump.
They couldn't do it anymore.
They stopped tumbling. So, it just. So there's another example. I mean, I mentioned the Fed model earlier, but just is another example that we have to pay attention to indicators and some of these assumptions we've made in the past and see if they're still holding up.
But when we go back to the concept still is, okay, are the central banks providing liquidity or not? Or are they cutting back on liquidity? And, how we measure that may change. So the indicators that we may have relied on or used in the past may change. But the concept of liquidity and that improving liquidity is good for financial markets doesn't change. So that's a tough thing to go through. That's what we as analysts and strategists have to deal with, is that there's change in the environment, but what does that change really represent? And that's why you don't necessarily always want to get locked into the indicators. And that's why when we went through rules of research, they're really principles. Really, they're not like, look at this indicator and look at that indicator. It's like, no, don't fight the momentum or don't fight monetary policy. How we choose to measure that may change. But the concepts, the principles are still there.
So I'd be interested to know what you're working on at the moment.
We've been doing, what I've been doing really over the years is trying to develop reports where, so that we can really see, we talk about breadth, and we want to see how broad various conditions are around the world. So we have the All Country World Index. All Country World Index is 54% the U.S. We want to understand, is the U.S. driving the global trend, and therefore are we seeing a lot of divergences, or are we getting confirmation globally? So we've developed reports, and we just introduced another one similar to something Ed had done. It looks at earnings expectations, consensus estimates, and then you can look at the correlation, the consensus estimates to the market, and see, does the market correlate with current consensus estimates for the next year? But more importantly, what I've done is we developed this report so we can see how consistent is the momentum of the estimates. We have another report that looks at earnings revisions, percentage of companies that are beating their earnings revisions. And what we want to see there, are we seeing breadth of, what we've been seeing is earnings downgrades around the world. Is that changing? Are we seeing areas of the world where maybe emerging markets starting to look better? Are we seeing sort of, Alejandro talks about green shoots. Are we starting to see signs of that in the earnings data? Forward, we have a report that looks at trailing earnings compared to forward earnings. And you can compare the two, to Ed's point, oftentimes, it's the trailing earnings coming down to such a point, maybe all the bad news is in, but the forward earnings are starting to stabilize. That would be a good sign. We have reports that look at the median earnings yield of across sectors and markets, median component earnings yield. So it gives you breadth, so you don't get this top-down number, you get a sense of what is the average stock earnings yield. And we can do that for the All Country World Index and all the countries. I can go on, but we have developed a lot of these reports to kind of see how broad-based things are around the world. And that helps us understand, are we starting to see signs of, that helped us last year because Asia was clearly the focal point of the slowdown early last year. It started to show up in a lot of these divergences. And we see it both in our internal indicators, but also in the fundamental indicators. And I rely on our global macro work as well. When we started seeing the PMI started to roll over, the recession probability models started rising. So, again, it's part of this 360 approach. And I just think the more, first of all, the more data we can look at, the better. The more global we can make the assessment, the better. See if we can identify where maybe things are starting to turn in a particular part. So that's what I'm working on right now.
How about you, Ed?
Well, yeah. So one thing is buybacks. Trying to quantify the impact and maybe do some myth busting out there on how influential they are and what they mean. In particular, there's been a lot of work on the so-called blackout period. It's not an official rule, but a lot of companies do suspend their buyback programs a few weeks before they report earnings. And historically, the market has done a little bit worse when there's been more companies in this blackout period. But last couple earnings season hasn't really been the case. So looking into why there. But probably the bigger project is this long-term view of growth versus value. Growth has been outperforming value for 12, almost 13 years. And that's by far the longest run on record. Historically, value stocks outperformed growth stocks. You bought stocks that were cheap, you got rewarded for it. Why has that changed? Probably has to do with a lot of economic conditions. But then, is this going to go on forever? Most likely not. And so, what sort of things are going to lead us to believe that value stocks are going to outperform again? Probably would have to do with better economic conditions, a different Fed regime, and different sectors outperforming. So, but we're gonna dive into that, have a good report out in the next few months. And then the third thing is on dividends. Because of the low interest rate environment, a lot of investors want dividends as a way to get income because they can't get all of it from the bond market without taking on a lot of risk. But as the Fed is trying to normalize, what does that mean for dividend stocks? What kind of dividend stocks should you be invested in? Because again, most people can't just say, I don't want dividend stocks. They need them. So how do you navigate that? So those are some of our areas.
Always a lot of things working on, but two I would say that are more front and center for me right now is cross asset volatility. I don't think we really have done enough on vol and volatility, and there are newer indexes out there to allow us to capture this, and it's just a good way of sort of looking at the markets in a non-price, pure price way, but still see the result of price. So it's just a little different way of looking at things. And second thing I'm trying to work on is creating our own financial conditions index. So there are others out there, but it's going to be a little bit different than those. Most of the ones that are out there want to show the relationship between financial conditions and economic results thereafter, and I'm less interested in what the economy does. I'm more interested in what the markets are doing.
Normally, to wrap up, I ask a guest if they have 3 tips that can help investors improve their investment decision making. I have 3 guests, so maybe if I can get one suggestion from each of you, what are some things that could help investors with their decision making?
The first thing to do is don't take the headlines seriously. If you do, you're going to get caught up in the sentiment and you're going to end up on the wrong side of a major move. For example, I would say one thing I've been noticing this year, there's a headline that says, progress on trade talks, market up. 3 days later, trade talks stall, market down. Yet nothing has happened. So it's really just about sentiment. Somebody says something about the trade that leads people to explain what the market's doing, when maybe it has absolutely nothing to do with the trade talks at all. So I would be very cautious about taking any headlines very seriously about why the market's doing what it's doing.
those 9 rules of research are probably great ones to focus on. But I'd say just know your end game for what you're trying to do with your investing. I've got college saving plans for my kids, and one of them's getting close, and so I need to think about my risk profile for her college plan versus my other kids who are younger. It's different. So keep that in mind when you're thinking about any investment decisions you're making, so that you can you can really meet your objective. And that's what we're doing here. We're trying to better our lives by getting ourselves in a better financial position. So make sure you remember that.
I think what's become really important is to look at both a variety of indicators, so we make sure we cover the landscape and we're not missing anything. And I also think it's important to listen to a variety of views. And I think there obviously are some people who are better than others. I don't want to go too far out and just always listen to a perma bull or perma bear just to get sort of the opposite take on things. But just to understand what might be going on in the markets that I may miss. And there are a lot of smart people out there giving interviews. There's access to these information. Some of it's easier to access than others, and some of it's only geared for professionals, and some of it's geared for retail. But understanding the various perspectives that people have and why they're coming up with their views is very helpful in constructing my own view, or at least thinking through why I might be right or where I might be wrong. And once you have a broad understanding of the views and the indicators, then you could be more at peace with your own decision making.
I'd really like to thank you all for the time that you've spent with me this morning here in Florida, going through what you do and your approach and your views to the markets. It's been great for me, and I'm sure our listeners will appreciate it very much. Tim, Ed, Joe, thank you for joining us on the i3 Insights podcast.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.